Choosing between gold and stocks often feels like choosing between a fortress or a growth engine. Both have important roles in a portfolio, but their operation is like heaven and earth. Here is an in-depth comparison to help you determine which is more profitable according to your risk profile. Gold, the safe haven. Gold has been considered a valuable asset for thousands of years. In the investment world, gold is often referred to as a safe haven. Profit inflation. Resistant. When prices of goods rise and currency values fall, gold prices tend to rise. High liquidity. Very easy to resell at gold shops, pawn shops, or digital platforms. Physical assets provide a sense of security because they are tangible and cannot become zero, unlike company shares which can go bankrupt. Lack. No cash flow. Gold does not pay dividends or interest. Profits are derived solely from the difference in selling price. Capital gain. Storage costs. If you have a large amount of physical gold, you will need a safe or a safe deposit box rental fee. 2. Stocks, the machine that creates wealth buying. Shares means you have a portion of ownership in a company. It's an aggressive instrument that relies on economic growth. Profit, high profit potential. Historically, over the long term, 10+ years, stock returns typically outperform gold and inflation. Passive income. Some companies distribute dividends, profits, regularly to shareholders. Compounding effect. Reinvested profits can multiply thanks to compound interest. Lack. High volatility. Prices can fluctuate drastically in a short period of time. High risk. Need. Analysis. It takes time to study financial reports so as not to choose the wrong company. Which is more profitable? The answer depends on the goals and economic conditions. When the economy is in crisis, gold is usually more profitable. During times of war or political uncertainty, investors panic and flee to gold, causing its price to soar. When the economy is growing, stocks outperform, companies expand, sales increase, and stock prices soar. Conclusion: the best strategy. Don't get caught in the trap of choosing either or. Wise investors usually diversify. Simple formula: use gold as wealth insurance to protect your assets from being eroded by inflation, and use stocks as the primary vehicle to accelerate your wealth growth. So, are you the type who prefers to hold shiny physical assets? Or are you more challenged by seeing growth figures on the stock exchange screen? Let's dissect it more deeply from the investment psychology side and when is the right time to enter each of these assets. If the previous article discussed what it is, this explanation focuses more on how it works in your life. Understand. The character of profit. Many people misunderstand and assume that gold and stocks can be compared apples to apples. However, the nature of their returns is different. Gold is honest money. Gold won't make you rich overnight. It simply ensures that the money you have today will still have the same purchasing power in 10 to 20 years. Example: if 10 grams of gold can buy a goat today, then in 10 years, the same gold will most likely still be able to buy a goat. Stocks are a growth business. Stocks can make you rich because you're leveraging the sweat and innovation of thousands of people in a company, like BCA, BRI, or Telkom. If the company makes a significant profit, you get a share of the wealth. When should you choose gold? Gold is a defensive instrument. You are better off holding more gold if unstable global conditions. There are issues of war, pandemic, or political tension between major countries. Emergency fund. Gold is suitable for storing funds that should not lose value but should be easily liquidated within 2 or 3 years. Fixed cost preparation. such as the cost of the Hajj pilgrimage or children's school fees, the value of which follows inflation. When should you choose stocks? Stocks are offensive instruments. You're better off investing in stocks if stable growing economy, low interest rates, high purchasing power, and development progressing smoothly. Very long-term goals. For example, retirement funds, 15-20 years away. Stocks have the power of compounding, interest accruing, that gold lacks. Be ready for the price storm. You must have a steely mentality when seeing your investment balance in the red, down by 20% in a day, with the belief that in the long term it will rise again. Simple simulation. Suppose you have $10,000. Scenario A. Gold. You save it in gold. After 5 years, its value might be $13,000. You feel like you've made a profit, but the prices of goods in the market have actually risen. You've only survived inflation. Scenario B. Blue chip stocks. You buy shares in a large, healthy company. After 5 years, the stock price might rise to $15,000. Plus, you receive a 3 to 5% annual dividend, cash. You win against inflation. Additional advice: if you're just starting out, don't choose one over the other. Try the 50-50 method. Over time, you'll learn which one best suits your heart rate when watching price movements. Are there specifics, areas like how to buy or risk analysis that you'd like to dig deeper into? Great! To make it more practical, let's see how to start both with affordable capital, because now investing doesn't have to require millions of rupiah. Start small strategy. How to get started in gold without hassle. Now, you don't need to buy 10-gram bars straight away. Digital gold savings. Many applications, such as Pegadaian Digital, Tokopedia, or Bukalapak, allow you to buy gold starting from IDR $10,000. Gold installments. You can lock in today's gold price and pay it in installments every month. Physical versus digital. If you want security, buy physical gold, Antam Yard UBS. If you want convenience for trading, use digital gold. How to get started in stocks for beginners. Don't just jump in and buy shares of unknown companies. Equity mutual funds. If you're not confident in choosing your own companies, you can entrust your money to an investment manager through an equity mutual fund. They will manage your money in the best stocks. Blue chip stocks. If you want to buy directly, choose blue chip stocks. Large companies that have been proven profitable for decades. For example, the banking or consumer sectors. Use cold capital. Don't use rent money or food money. Start with a small amount to get used to price fluctuations. Ultimate tip: rebalancing. This is the secret technique of pro investors. For example, you have a target, 50% gold and 50% stocks. Next year, it turns out that the stock price rises so high that your share portion becomes 70%. You sell some of the shares, take profit, then buy gold so that the portion is 50-50 again. This way, you automatically sell high and buy low. So, which of these two instruments would you feel more comfortable trying out this month? Here's a practical guide to help you get started, along with the risks you should be aware of to avoid getting caught in a fraudulent investment. Practical steps to get started for gold investment. If you're the type who likes to hold things, where to buy, come directly to the Antam Gold Boutique or Pegadaian.tip. Focus on gold bullion, precious metal, not jewelry. Jewelry has manufacturing costs that aren't included in resale costs. Storage. If you buy a physical copy, store it in a very safe and unexpected place. Don't put it in a regular wardrobe. For stock investment, if you want to start from just your phone, select securities, Download a securities application registered with the OJK. Examples: Stockbit, Ajaib, or IPOT. Simple analysis. As a beginner, simply buy stocks whose products you use every day, e.g. the bank you save at or the brand of instant noodles you eat. This is called the invest in what you know technique. Beware of trap holes, risks. Many beginners fail because of the following reasons. Gold price. Spread. Gold has a buy price and a sell price, buyback. The difference is typically 3% to 10%. So don't be surprised if you buy today and sell tomorrow. You'll lose. Gold takes at least 2 to 5 years for this difference to be offset by price increases. FOMO in stocks. Don't buy stocks just because what people say or because they're trending on social media. High-flying stocks usually fall quickly. Fraudulent investments. Whatever your choice, if anyone offers guaranteed returns, e.g., guaranteed 1% daily profit, walk away immediately. Legitimate investments fluctuate in value with the market. Checklist. Before money comes out. Before you transfer money to an investment app, make sure you have emergency fund, cash and savings for 3 to 6 months of living expenses, cold money, money that you will not use in the near future, at least 1 year.